All right, well, let's go ahead and get started. We've got quite a few of you in here, so let's kick things off. Again, I'm Jake Rushton. I've met hopefully a lot of you. If not, I hope to meet you soon. We have a special guest today giving us some really good advice. I'm going to hand it off to Jared. Jared Empey is our Boise advisor. He's based up there in Nampa. He does an amazing job. His background, I'll let him give a little bit of background too when I hand it off, but it's deep in accounting, which today, based on fees, is going to be useful. So we're going to talk a lot about things that will be even outside of your 401k and ways to improve your financial outcomes by keeping fees low. So without keeping my time going too long, I want to hand this over to Jared and let him take us into his presentation. Thanks again, everyone, for being here.
All right, thanks, Jake. Well, let me see if I can get my presentation pulled up here real quick. All right, Jake, are you able to see it here for everyone?
Yep, you're good.
Perfect. All right, so today, as you saw in the little paragraph explanation, we're going to be talking about the impact of fees and how to save costs, kind of in several categories, but primarily today just in your retirement accounts. So just to give you some more background first on who I am, I have a bachelor's degree in accounting, a master's degree in financial services. I've been in the financial planning industry for about 5 years now. I moved up to the Boise area about 4 years ago now to serve the Idaho area. Here's my beautiful family over here on the left, my wife Amika and 13-month-old daughter Charlie, which I just got to take sledding and experience the snow for the first time over the weekend. So that was really fun. We had a blast. My favorite food is Thai food, and I love to travel. I've been to Thailand, Paris, London, love international travel, as well as here in the US. I just love to get out and to experience all that is out there. But speaking of travel, how many of you have flown recently? It can be costly. There's a lot of things that add up. You have the ticket. Oh, you want extra bag? That's going to be a fee. You want 2 inches more in leg room? Oh, that's going to be $30. You know, there's fees for all these different things. And the same is with investing. It's a service, and therefore there is a fee to accompany it, but you want to make sure that you aren't being overcharged and that you understand where all your fees are coming from. So that's what we're going to be talking about today. And here's just a little comic that I found that kind of follows that same story about the travel. Here they're at a bank, it says, we're charging you a paper statement fee, a talk to a teller fee, and a walk in the bank fee. That's a lot of fees draining my account, which brings us to your overdraft fee. I love that. That's great. I'm sure you can all relate to experiences in your life where you just feel like you're being nickel and dimed over everything. And it can very easily be that way in regards to your retirement accounts as well. So you need to understand what is going on. So just jump into some fun facts here. I'm sure many of you have streaming services like Netflix, Hulu, Disney Plus at home, and you probably know how much that costs each month. Actually, 96% of people know how much they pay for those services. However, only 27% know how much they're paying for fees in their retirement accounts. A good majority don't even know that there is a fee on their retirement accounts, or they believe that they're not being charged a fee at all, which is most likely not the case. So to dig in, here's kind of the overview of what we're going to go through today. So we're going to mainly, like I said, talk about retirement account fees, and we're going to answer several questions. One is, what do you need to look for? What is a reasonable fee? How do they impact your performance, especially long-term if you have significant fee drag? And how can you reduce them? What are ways to lower the fees? And then we're going to talk just briefly about additional cost-saving strategies potentially in other areas of your finances. All right, so to jump in here, we're going to talk about the fees that are associated with retirement accounts. You're going to have the advisory or the management fee. That's going to be the fee that is paid to the advisor or the brokerage firm that you're working with. There's transaction fees. There's account platform maintenance fees. It's usually an annual fee to have the account simply open. The expense ratio, which is the cost to own a fund, and commission-related fees that are usually tied to a product, service, or fund. So to break these down a little bit more, let's talk about advisory and management fees. So there's typically 3 structures in which advisors set up their fee platform. There's what's called commission only. Now these are brokers or firms that are selling products and services for commissions. And it's not that all commission servicers out there are bad, but however, it does put mud in the water. It kind of becomes a little bit harder to see whose interest is truly at heart. Is it yours, or is it the salesman who's trying to sell you these products and services for that commission? So you just need to be on your guard a little bit. There's also a structure called fee-based. This is where there could also be some commissions for products or services, but there's usually a fee that is attached to the assets that they are managing for you. So let's say you have an IRA, for instance, with $100,000 and they're charging a 1% advisory fee. Well, that's going to be about $1,000 annual charge to your account. That's how that works. And then there's the fee-only model. Now, fee-only charges that same, usually a percentage fee based on the account that they have under their management they're helping you with, but they do not charge any commissions on services, products, anything like that. Occasionally, there could be a negotiated flat rate as well if they were doing some hourly work or case-by-case work there. But what really stands out about fee only is that they usually hold themselves out as fiduciaries. Now, a fiduciary is someone who is legally obligated to give you advice in your best interest. Now, you may think, wait, shouldn't all advisors give me advice in my best interest, or at least be legally required to? And unfortunately, that's not the case. There was a law that was trying to be passed in 2017, 2018 that would have pushed all of the advisors that direction. Unfortunately, it did not pass. And thus, you need to be on your guard and really do your research as to whether your advisor is a fiduciary or not. All right, so what is the industry average fees when you're talking about these advisory fees? What are people charging out there? So if you're looking for wealth management, someone to go over your risk tolerance, to create an investment portfolio that is going to help you reach your goals according to your time horizon, your risk, and as well as help you with a personalized financial plan, hopefully in all areas of your financial life, industry average right now is about 1%, which isn't terrible. I've seen as high as 2% lately. So 1% is okay, but there could potentially be other options out there that are even lower. Now, if you're looking only for investment management via a robo-advisor, so usually an internet-based programming, a website or software, you may have heard of Betterment.com, or Vanguard has an advisory service like this. It's going to be significantly less. You're not going to have a lot of hands-on help. It's only going to be in regards to the investments. You're going to see a fee between 0.25% and 0.4% annually. Now, if you are with a retirement plan, an employer-sponsored retirement plan, you have a 401k at your workplace, it is common that fees are quite low for the advisory fee, sometimes even ranging as low as 0.1% up to usually no more than 0.6, 0.7%, but sometimes I've seen them as high as 1%. So they're usually lower though, about between zero point 0.1 to zero point 0.5, because you're dealing with a larger amount of assets. So by everyone kind of being together on the same plan, it's doing you a favor of lowering that fee for you. So there's also the transaction fee. And what that fee simply is every time you buy or sell a fund, there could be a trading cost that occurs. So even if every time you're making that contribution into the retirement plan to buy into a particular fund, there may be between $10 to $50 charge every time you buy into that fund. That really depends on the custodian or the brokerage firm that you're working with and what they charge. It could be that they include that in their advisory fee and that they don't charge it on a per buy and sell basis, but it's kind of more just a lump into the advisory fee, or they may have the option to waive it altogether. So you just want to really be aware of this, especially if you're doing a lot of buying and selling. It can really rack up that fee if you're not aware that every time that you are buying and selling, there's this fee that is occurring. All right, and then we get to the account maintenance fee. This is a pretty generic fee. You probably have this on your bank accounts. You know that if there's an annual fee to keep the account open per year, just to have the account, between $25 to $100. It's the same thing in the investment account world. There's usually an account fee as well. However, this fee is usually waived once the value exceeds a certain amount. And this could be important, and you want to make sure you understand what that amount might be. For instance, I recently met with a client who had a cash reserves account open at Vanguard, had about $3,500 in it. They were just starting out their emergency fund, and it was slated to earn 1%. Well, 1% on 3,500 is about 35 bucks that it would earn in interest over the year. However, if the account balance was below $10,000, there was a $35 annual maintenance fee. So they said, I'm told I'm going to get a 1% interest rate on this account. However, I've looked at it now a year ago and now a year later, and it's showing the same balance. And it's because that maintenance fee was negating that. So you want to be aware of those occasionally. And those may be waived altogether as well. All right, now this is what are called expense ratios. And what an expense ratio is the cost to own a fund. Usually a mutual fund or a exchange traded fund. They're usually not attached to individual holdings per se. If you wanted to go and just directly buy Apple stock or Amazon stock, you're not going to usually have an expense ratio. And the reason why is that expense ratio is charged because there's a fund manager that is helping organize that fund and trying to create the components inside of it to create a good outcome. And of course, that work going on isn't free. And so there's an expense ratio that is charged so that that fund manager is paid essentially. And so these commonly range between 0 to 3%. You may be familiar with Vanguard. Jim or Jack Bogle, who is the founder of Vanguard, really revolutionized the investing world for the retail investor who didn't have a ton of money to spend on these expenses to buy into a fund and to drag down their returns. And what he did is he made it so that you could buy a worldwide fund with thousands of holdings in it for a fraction of the cost of what it used to cost to buy that at the time. So usually you can find Vanguard funds in the range of 0.1% to 0.3%. and have a great fund. There's even lower fees than that. iShares is another common fund that has very low expense ratios. But sometimes it could be more appropriate to pay just a little bit more in an expense ratio depending on how that fund has performed. So you also want to be aware of the historical returns and see what the historical fee net of the expense ratio plays out to be to help you make your analysis there. Sometimes, as well as attached to those expense ratios, are what are called the 12B1 fee. And what this is this is an advertising and promotion expense, kind of used for marketing that some funds do, and that can make up to 1% of the expense ratio. Not all funds have this, so you want to be aware that if you do see a high expense ratio, there could be a 12B1 fee associated as a part of that, and there could be more efficient options. So these expense ratios usually aren't explicitly told to you when you're sitting down with your advisor. They're usually on the back end, usually hiding somewhere in the fine print of the funds that you own, and you might not even see them until you Google the fund that you're actually in. So it's important to be aware of your expense ratios and ask your advisor, hey, I saw that this expense is, kind of high, maybe 1% or so. Is there a reason why it's that high? Is there other more efficient options? And kind of dive in a little bit more so you understand what your funds are actually costing you to own. All right. So now we're gonna get into the heavy stuff here. So then there's what's called a sales charge or a load occasionally. And these are usually attached to mutual funds as well. And usually these are in the fine print as well, or on aggregator tools that you can look up like Morningstar. You can find these. So these are commissions, and let me tell you a story. So I recently met with someone and I said, I was just asking about their advisor, and they said, yeah, my advisor's only charging 0.7%. Well, that's lower than that 1% industry average. So I said, hey, that's pretty competitive. That's pretty great. And then I asked him a little bit about the funds that he's invested in. And as he was telling me about the funds that he was invested in, one of them really caught my attention because I knew right away that there was a 5.75% sales charge attached to it every time money went into that fund. And that's what's called a front end load, where there's that commission being hit right as money enters into that fund. And he was going to have about 200,000 rolling over from his 401k at his work into a traditional IRA where this fund was at. And 200,000 on 5.75% is $11,500 that he would have been smacked with right away. And he had no idea that there was that 5.75% commission. His advisor had never told him or pointed out that that's how much the fee had cost. He had simply only told him that the 0.7% was what he was going to be charged. And so you really want to try to dig into this yourself. And sometimes, unfortunately, you have to pry, but hopefully someone is going to work with you that's going to be as transparent as possible so that, you don't have to worry about what is in the fine print. But it's important to look at that. And then there's what's called a back end load charge, and that's just the reverse, so that every time you take out money, there could be a commission charge based on that as well. A good example, actually, of a situation that's similar to this is if you have an annuity. So annuities usually come with what are called surrender fee schedules. And what that means is usually there's a stated amount of years, let's just say 10, to where if you were to take it out prior to those 10 years, there's usually a fee that's going to charge according to that. So if you take it out within 1 year, there could be a 10% fee. 9 years left, 9%, all the way down to 1%. And that could significantly take a toll on your investment, especially if you come in need of that money within that 10-year period. So you just need to be very cautious and aware that those things may be in place. And then there's what are called no-load sales charges, and that's just where a mutual fund simply doesn't have a commission or a sales charge. All that it's going to have in its purest form is just the expense ratio, and that's what you'll have there. All right, so by this point, you might be feeling a little bit like Woody here, and Buzz, oh, good old Buzz, saying service charges, fees, and taxes everywhere. Well, rightfully so. If you know that your fees are high, you probably do feel like Woody. But let's talk a little bit about how you can ease that, and let's see how the fees actually impact your performance. So investment returns, as you know, are not guaranteed. They are variable. They change all the time. Historic results are no guarantee of future performance. However, fees are. They're stated, and that fee is going to come out whether there is a negative year or whether there's a positive year in the market. So let's run through an example here. If you had about $30,000 in a retirement account with an 8% average annual rate of return over the next 30 years, and they're charged an annual fee of 2%. So that would include your advisory fee, your expense ratio, just all the fees combined. Let's say they end up being about 2%. After those 30 years, if you don't contribute any more additionally into this over that time, let's just say you put the 30,000 in and just left it there, you would then have $172,305. Okay, but let's compare that to a 1% fee over that same 30-year time. You now end up with $228,368, roughly $56,000 more than you would have had if you were being charged 2%. Now, I don't know about you guys, but 56,000 sounds like a great a great chunk of retirement, and that could really be potentially 1 to 2 years, maybe 3 years, depending on your burn rate in retirement, how much you're spending, and really elongate your nest egg there that you've built up. And that's just on $30,000. Let's say you have $100,000, so now we're multiplying that a little over 3 times. That's going to be over $150,000 in savings. So 1% differential is really significant, especially when you compound it over all those years. All right, so let's say you do know that you have higher fees, or you're just simply trying to figure out where you're at. The first step, of course, is to identify what your fees are currently at. How high are they currently? Dig in, find all that out. Your advisory fee, if there's transaction costs, the expense ratios, do your homework. Try to dial it in there. And then shop around. I recently had a meeting with a client who was kind of in the dark. She was very trusting of her current advisor, didn't really ask about the advisory fee because she just thought she was getting a great service. And then recently it came to light how much she was actually paying. And it really opened her eyes. She's like, wow, I had no idea. So she started shopping around, came in contact with myself, and fortunately, I was able to show to her that I was able to save about half the cost that she was paying in fees. And, that is huge. Half the cost is every year compounded, especially when you're putting that back into the investment and it's compounding at a a good return rate, you're going to have a great outcome. So shop around advisors. You could even do your due diligence, and every year some people just shop around to see what's out there and if they can get a better value for the price that they are paying. Maybe more services, maybe it could be even the same fee, but they're getting more services with another advisor than they are under their current advisor. That would be a better value for that fee. All right, oh, let's see, there's a little hiccup in my thing here. Let's see if I can advance it, okay. And then you want to compare funds. Again, you want to see how high the cost of your funds are, what the expense ratio is, if there's those sales charges. If you have control of your portfolio through your 401k, you might want to evaluate other options and maybe decide to shift into more efficient, less costly alternatives. If you're working with an advisor, just have a conversation with them. Again, like I mentioned, why do these funds cost what they do? Are there cheaper cost funds out there? And just learn more about that, because as you saw, everything adds into that drag. And then as well, just beware of commissions. Again, not all commission guys are bad, but it can truly, you just don't know sometimes whose interest is best at heart, and it can add significant drag to your performance. All right, so let's jump into a few additional tips to save costs in your finances. We're gonna have some questions at the end. So if you had any more questions about the retirement fees in general, go ahead and start throwing those into the chat, and then we'll get those here after I run through this section. So additional tips, let me, yeah, first thing you wanna do is run to your local hardware store and buy a clamp and clamp your wallet. I'm just kidding, but I thought that was pretty funny. All right, so refinancing your home. You've probably actually heard of a lot of people doing this recently. And the reason why is rates are really low right now. I have a bunch of mortgage and loan professionals and realtors that I know and converse with, and they're just shocked that the rates have stayed this low now for about a year. If you bought a home, prior to that, it was probably up in the 4% to 5% range. So 3.5% for a mortgage refinance for a 30-year fixed is pretty great. So I'm just going to run through a simple example here of how a refinance might work out for you. So let's say you have a $300,000 30-year fixed mortgage. Your interest rate is 4.5%, and so your monthly payment is $1,520. Now that's just the mortgage payment. I didn't include into that potential PMI, property taxes, escrow, home insurance, anything like that. That's just the pure mortgage balance payment. So let's say you refinance a couple years into the mortgage after rates have dropped more than 1%. You're now hearing, wow, rates are 3.5%. That's a whole percent less than I originally took out my mortgage for. However, there's usually a cost to refinance through your loan officer, and it's generally depending on the value of your home, but for a $300,000 home, it's probably going to be around $10,000. So let's say that brings the loan balance to $285,000 because you paid some off over those 2 years, but then the cost of the refinance. So your new monthly payment would be about $1,280, which is a savings of $240 a month, or $2,880 a year. So if you do the simple math there, it would take just under 4 years to break even to that $10,000 expense. And then after that, you're just saving money. You're just putting more money in your pocket that you can then put to work for you elsewhere. So it could be a good option to refinance. Now, another way that a refinance might be helpful to you is, let's say that you were just getting started you wanted to get into a home, so you did the full 30-year fixed, and now a few years into the mortgage, let's say 5 years down the road, you're more established in your career, you're bringing in significantly more in income, and you could potentially afford a higher payment. You may want to consider refinancing to a 15-year fixed, and then usually 15-year fixed rates are even lower than 30-year fixed, and you'll have less time to pay that off, meaning less compounding of the interest, and you'll end up paying off. Your total cost of the mortgage will end up being significantly lower than if you would have dragged out the whole 30-year fixed mortgage there. So sit down with either a banking professional or a financial advisor and run through the math and just see if it works for you. In this scenario, obviously, you're going to want to be in the home then for at least 4 to 5 years. If you think you're going to be moving within that time period, it probably wouldn't be advised to do the refinance because the cost turnover just won't make sense. All right, let me switch here. All right, so a few additional ways to save. So the same methodology applies also to refinancing student loans and auto loans. If you can get a better rate for those, absolutely try to get a better rate. And if you have additional income, you might want to even consider accelerating some of those to have less interest compound over time, depending on what the rate is. And then if you have high credit card debt, you probably get in the mail all the time those balance transfer promotions. It might be a 0% APR over like an 18-month period or something like that. And of course, those could be really enticing. However, it's important that you evaluate if you can pay it off during that 18-month period. Otherwise, there could be back pay interest on your whole balance, and that could be really harmful there if you didn't pay off that amount. As well as there's usually a 3% or 2%. There's usually some sort of fee for initially doing that balance transfer in the first place as well. So you just want to make sure to do the math and make sure that it's gonna save you. As long as you can pay it off in that promotional period, it usually is, because your credit card rates are probably between 15 to, I've seen as high as 24% lately. Another option is to consider taking some of that equity out of your home in the form of a HELOC, a home equity line of credit, and paying off your really high interest rate student loans and kind of leveraging a lower interest rate, which would be the HELOC, which currently has an average around 6.1%. That 6.1% is going to be a lot less in compounding over time than that 24% credit card. So you might want to consider that as well. And then the next step, of course, after you do that, is just going to be to cut up your credit card. You just need to try to lower your expenses so that you're not having a rolling credit card balance. And there's a lot of ways to help you do that, like creating a budget. So I would really recommend creating a budget if you don't have one. That way you can monitor your spending and evaluate ways to cut back. There's really helpful tools out there nowadays like Mint. That's kind of like an aggregator and keeps track of all your expenditures. You can even categorize them. Dave Ramsey has a great one out there called You Need a Budget. And I would recommend reviewing this at least monthly. And if you're married, doing it with your spouse. That way you're on the same page, and you can work together as a team and say, hey, let's cut back here, let's cut back there, and see what we need to do. And then just as you want to reshop around for your advisor, it could be helpful if you reshopped for your property and casualty insurance occasionally as well, and see if there's better premiums out there, lower premiums, etc. And then you want to avoid permanent forms of life insurance, such as whole life and variable universal life. Those usually come with a very heavy commission cost and can take quite a long time to recoup that cost, as well as they don't end up being the most efficient vehicle when it comes to a savings component that they're usually advertised as. And you can be more efficient elsewhere with that savings component, and you usually get a better, a cheaper life insurance policy for the death benefit by looking at term policies, like fixed level term and not variable level term policies there. So I hope that was helpful today. It kind of just grazed the surface there, but I hope it gave you some ideas. It gave you some homework to go look and to see what your fees currently are, maybe look into refinancing, starting a budget, things like that. But let's review some questions now. Let me see if I can get to the question page here. So, let's see. Jake, are you able to see any questions? I can't get to the chat here yet.
I don't see any questions in there right now.
Okay.
So if anyone has any, they can either raise their hand and I can unmute you, or let me turn my video back on. So if you do that, we can get questions answered. But I'll just, while we're waiting for any final questions, add a couple things. I mean, here's kind of the goal. We wanted you to learn from this is there's more likely a chance like that you have at least one way you could save some money, and fees are always negotiable. I mean, that's the part that I've always found. Even when we're managing your 401k, we're continuously working with the vendors to keep those fees down and reducing them again and again. As some of you may have gone through changes over the last couple of years, the reason for those changes oftentimes is to reduce your cost. So in other aspects of your financial life, if you'll do that, I think that'll really be a benefit to you, because the further along you get in life, the more you save, the more important those fees can be, because they're a lot of times based on the size of your account. So be very, very vigilant and get after that. So that's my challenge to you, is find at least one way to lower your cost in one area of your financial life this week. If you can do that, I think that's a great goal, and was something that would make us at the True North team and the IMAFS team very happy to see you do. And so if you have questions or things come up that as you start to dig deeper into those things, let us know. We want to be of use to you. I just saw a question come in, Jared. Said, under the age of 34, and some of the terminology I don't quite understand. What is equity? So
yeah.
Equity, do you want to, I'm not sure if we mean, I'm assuming since we were talking about equity of home, but yeah, Jared, do you want to talk about maybe, you think you mentioned equity a couple of times, but I'll let you answer that.
Sure. So equity can take a couple different forms. So if you're talking about investments, equities usually refers to stocks or holdings that you have in investments. And then if you're talking about your home equity, it's usually the difference between what the value is of the home in comparison to what you owe on the home. It would be considered your equity in the home. And usually you can draw on that if you needed to in the form of a home equity line of credit. That's what I was referring to there. Did that answer your question, Danny?
I'll even add to that. I think since we talked about homes a little bit, it's sometimes confusing the different products and ways that you invest money. Wall Street puts things together in ways that help hopefully people invest, but also in ways to create fees and things. So the way I look at it, every single financial product you ever could invest your money in is either going to be basically a stock or a bond. And the easiest way to understand that is think of your home. Equity, you buy your home at a certain price, it goes up in value. Just like if you own ownership in a company in a stock, same thing happens. You don't necessarily have to check that value every single day, but you do want to know it when you're going to sell it. So you kind of expect that to continually go up. The opposite of that is a bond where you're actually lending money. That's the bank's role when you think about your house. They're lending money to you. You would be the lender in the case of buying a bond. You would lend the money out and they would pay you back. So that term equity gets thrown around a lot. And I think understanding what we're referring to is important. So yeah, that's a great question. If there's other terminology that we say too quick, let us know, because sometimes we don't realize we're saying it because we every day talking about it. So
Absolutely. And if you need to review any of what we talked about today, Jake, I believe this will be going up recorded on YouTube or something like that as well later on.
We'll put on YouTube and we'll email it out to everybody so you can share it with and watch it with someone else if you had more questions and wanted to review some things.
Awesome.
Okay. Well, if there's no more questions, we will go ahead and just wrap it up. If you do have questions, you're going to get a follow-up email that will give you the video and then a way to schedule a time to chat with us. We're available to help you, and it doesn't cost you to reach out. So please, if you have questions, let us know. We want to help you, myself and Jared, and we have more people on our team that'll help too. So hope everyone has a great day. Have a great lunch, and we will see you next month. Quick announcement: next month we're going to do this again, and it's going to be about maximizing your tax advantages. So understanding the tax code is a very difficult thing, and whether you have a CPA help you or you do it yourself online or through some software, there's a lot of changes every single year. And so we're going to dive a little deeper into some of those and give you some tips and pointers as you head into that tax season. Maybe some of you have already done your taxes, but those of you that haven't, hopefully we'll be able to find some ways that you could maximize a little bit better in this year or possibly for next year. So make sure you put that on your calendar. It's the same last Wednesday of the month. So hope to see you there. Thanks, everybody.
All right. Thanks, everyone.
Jared? Okay.
Well, that's
Thanks,
all.
everybody.
Have a good day. See
All right. Bye-bye.